another big rate hike is expected.
The market is expecting that the economy is going to slow, and that will solve all of the inflation problems, or at least get the Fed into a position where they will shift their focus from inflation more to growth.
I don't think the Federal Reserve is ready at this point to put its guard down at all about inflation. It's unfortunate what I think you just heard from Steve Leisman. The economy has already reached a fairly close to stall speed. It's carrying a heavy burden of inflation that's slowed the economy down. And the Fed's tightening is actually going to impact the economy most, probably in the period after inflation already recedes.
Hey everyone, welcome back to my channel. The Federal Reserve has a lot on its plate right now. With red-hot inflation on the one hand and deteriorating economic growth on the other, they gotta do a huge balancing act. And the results of their meeting are just around the corner. Oof, can't wait. I mean, the US Fed, which raised interest rates by 75 basis points in June to a range of 1.5 to 1.75%, is likely to deliver another large interest rate hike for the second time in a row to stamp out inflation, which jumped to 9.1% on an annual basis in June. Worry not, I'll keep you updated with every bit of news. So if you're new to my channel, be sure to subscribe and also hit that bell icon to never miss out on any of the latest updates on crypto and the market. In this video, I'm going to cover Cathie Wood's viewpoint on recession, market conditions, and Fed's hike and consumer sentiments. Let's first hear her out.
I know I've focused on the yield curve many times. It is flat. It did go negative for a time in April. We've never, in post-World War II experience, seen the yield curve invert without a recession soon thereafter. And we think we're in a recession, and that it happened as the yield curve was inverting, which was a quick response. Now, what I'd like to feature this time is the history of yield curves. And when we've moved into crises, we've seen monetary and fiscal authorities, easing quite significantly, trying to stimulate the economy, acting as a counterbalance. And often, and certainly since the early 90s, when this has happened, the yield curve has steepened to the 250 to 300 basis point range. So that's 2.5 to 3% range. And what this means is long-term interest rates are 2.5 to 3 percentage points higher than short-term interest rates. And the reason for that is investors begin to worry about the inflationary ramifications of fiscal and monetary stimulus. So 250 to 300 is where I thought we went in the middle of the COVID crisis, because we have never seen monetary and fiscal policies as stimulative as we did during the coronavirus, when we thought we could enter a depression, just the economy, global economy shutting down. So I was surprised as we looked back to see that the yield curve steepened only to 150 basis points, or 1.5%. What does that mean?
According to Cathie Wood, we've never seen monetary and fiscal policies as stimulative as we did in the COVID crisis. But she was surprised as the yield curve steepened up only to 150 basis points. Stay tuned to know what that means. Talking about yield curves, the inversion on the US 2-year 10-year yield curve accelerated as much as 24.40 basis points a few days back this month. This is the most inverted in nearly 22 years. Yield curve inversions are widely seen as precursors to recessions. Analysts have broadly warned that the Fed won't be able to achieve a soft landing for the economy amid soaring inflation, and many top firms on Wall Street have forecasted heightened risks for a recession. Talking about recession and Fed, everyone's eyes are now focused on the Federal Reserve meeting statement. How much hike can be seen? That's the question on everyone's mind. Now we can already see that the Bank of Canada raised its key interest rate by a full percentage point on Wednesday, making the largest single hike since August 1998. The Canadian dollar soared on the move, rising more than 0.5% to see $1.2952 per US dollar. Yields on 2-year sovereign bonds jumped about 10 basis points to 3.31%. Now Governor Christopher Waller has in the past few weeks signaled that the central bank will deliver the same size interest rate increase as last month, So will it be 75 basis points or a 100? Let me know what you think in the comments below, and if you find this video informative, be sure to like.
I think it confirms that the bond market, in its wisdom, was beginning to worry about deflationary undercurrents. And so to see it flatten so quickly and having only gotten to 150 basis points is very interesting. And so what are some of these? Oh, there's one other note. The last time we saw the yield curve after a recession or during a recession getting only to 150 basis points was in the early 80s. Now, inflation and interest rates were raging at the time in the double digits, and the Fed had gotten very, very tough. The dollar was rising fairly dramatically. And what happened was the Louvre Accord was when Treasury authorities from around the world all got together, including the U.S. Treasury Secretary, and said, okay, we've got to supply the world with dollars. We'll sell dollars and borrow and buy back the other currencies. And that's what happened. So the dollar back then was very deflationary, especially for emerging markets who had a lot of debt that was denominated in dollars. So their currencies were falling apart, but their debt was denominated in dollars. And so it was becoming much more expensive for them to service that debt. We may have a similar situation.
The US dollar has been on a tear recently, gaining more than 10% against a basket of major currencies over the past year. This surge in the value of the dollar has caused headaches for companies that do business overseas and has weighed on the stock and crypto market.
We think we're in a recession, and we think a really big problem out there is inventories, the likes of the increase of which I've never seen this large in my career. And I've been around for 45 years. And we're talking about the best managed companies in the world. If you're talking about Walmart and Target, they know how to manage supply chains. So if they have problems, we think there are a lot more problems. And then the other thing that's going on is the consumer is railing against these price increases. Consumer sentiment, as measured by the University of Michigan, which we think is the best measure out there, is down to record low levels, below 08-09, below 80 and 81. I had just started my career, and inflation and interest rates were in the double digits, 15, 20%. And consumer sentiment today is lower than it was back then. And most interestingly, in the last report, many people think, oh, the heavy spenders will keep this thing going. Consumer sentiment in the highest income groups is lower than in the lowest income groups, and the latter group is being, tormented by food and energy prices, which are really a regressive tax increase here to them.
According to the University of Michigan, the U.S. Index of Consumer Sentiment is at a current level of 51.10, up from 50.0 last month, and down from 81.20 1 year ago. This is a change of 2.20% from last month and minus 37.0% from 1 year ago. Consumers are really feeling the pinch of inflation as the costs of food and energy have increased. Inflation has eroded purchasing power and put pressure on household budgets. Now the question is, how hawkish is the Fed going to be this time? Can we see the same as Canada's central bank's surprise, or will it be 75 basis points? How will all this affect consumers? Let me know in the comments below. That's it for today. In my next video, we'll take a look at the Fed's decision and what the implications are for the economy. So don't forget to hit that bell icon. Also subscribe, share, and like this video. I'll see you in my next video. Adios!